Investing in index funds instead of other strategies. I mean, I am happy to tell people the same thing I've told them before, but they'll never get to see most of them. But if you do, that's the most, first thing to do, if you want to invest for the long term is index. And it's the S&P 500 index. Let me give you a figure that'll blow your mind. I think I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75, create 3 shares, $114.75. If I put that $114 into the S&P 500 at that time and reinvested the dividends, think of a figure to what it would be worth today. Oh man, the answer is about $400,000. This investing strategy is for the more illustrious type. The guys who don't mind a little bit of risk. It's like the attacking style when you play a game of chess. Growth investing is where you invest in companies that have more risk to them, yes, but have more potential on the upside. The innovative stocks, the technology stocks, the disruptive stocks that are changing the world. The Teslas of 10 years ago. And growth investors have done very well over the past decade as the world has changed and as technology has spread. Growth stocks like Amazon, Apple, Tesla, Netflix, Alphabet, and Matter all shot up like a rocket. The key with growth investing is to weed out the good growth stocks with a proper business model from the junk, because there is a lot of junk. Also, you want to try and invest at the start of the bull market instead of at the end of the cycle. And this is why I'm kind of a little bit wary of growth investing at this point in time, as we have experienced already a long bull market, and that bull market is going through some turbulence, we can say that in the least. Cathie Wood, Chamath Palihapitiya are 2 investors who do follow a growth-oriented style of investing. Although they did well to start with, they have struggled a lot this year, especially Wood. As we can see, her fund ARK Invest started with a bang, but it is now broken even. It's at the same price that it was a long time ago. Be wary when you adopt this style of investing, because this style will struggle the most if the economy continues to be on edge. While growth investing struggles when the economy is unstable, volatility investing thrives. People like Michael Burry from The Big Short love these types of conditions. I'm not sure if you've watched the movie The Big Short, but essentially in that movie Michael Burry shorted the housing market in 2008 and made a bunch of money as the market fell. Michael Burry profited from volatility. Volatility investing. You can either do the Michael Burry approach and short stocks on the way down, or you can do the George Soros approach and ride stocks on the way up. He also short stocks on the way down, but he does ride stocks on the way up. This approach can be quite risky, and you need to have your finger on the pulse at all times, but if done right it can make a lot of money. Those are the 5 styles to investing in the market. If you want to see the styles that I personally implement and the way my portfolio looks like, there is a link to that in the description below for premium viewers. Have you ever been on those stock websites and you see hundreds of ratios and numbers everywhere on a screen? Yeah, it can be pretty confusing for an experienced investor, let alone a newbie. So let me explain some key ratios and numbers to know if you understand them already. Skip to the next one. A good test for you all to do is how many of these 12 ratios and metrics do you already know? Okay, tick them off the list as we go. So price per share, or price per stock, simply tells you the price that will cost you to buy a share. Pay that price with your stockbroker and you will become a shareholder. The market cap of a stock tells you the total value of the business. Market cap is calculated by getting all of the shares in the business and multiplying it by the price of those shares. For example, Apple's market cap is $2.3 trillion. So if you wanted to buy the entire business of Apple, you would need $2.3 trillion. Tesla is $525 billion. Netflix is $140 billion. The dividend yield compares the price you pay for a stock to the yearly dividend it gives. So if the dividend yield is 1.5% like it is with Walmart, if you bought $100 worth of Walmart stock each year, you would receive $1.50 in dividends. Right now the average stock on the American market has an average dividend yield of 1.66%, so use that as your benchmark when looking at dividend stocks. If you ever see the letters EPS, that stands for earnings per share. Earnings is the same as profits, aka revenue minus expenses. Obviously you want earnings to be as high as possible, get the most profit, the most money as possible. The PE ratio is one of the most important ratios to know, because price in and of itself is not important. Price relative to profit is very important. The PE ratio compares the price you pay for a stock to the earnings that stock brings in. All else remaining equal, you want the PE ratio to be as low as possible. If you have a PE ratio of 6, that means if earnings stay the same for 6 years, you will get your money back. After that period, you'll get your money back in 6 years. The price to book value compares the price you pay to the book value you get in return. Book value is the value of the stock on paper. If you were to sell all of the assets of the business and pay off all of the liabilities, the book value is what's left. You want the price to book value as low as possible. Back in the day, Warren Buffett used to buy stocks that had a PE ratio below 1. This means he could buy the entire business, sell it off, and also make a small profit because the price he paid was less than the net asset of the business. He used to call this the cigar bar approach, where he would find a smelly used cigar on the ground, smoke the last puff of it, get that final bit of value, and then discard it. Remember, as I said earlier on, that a business's main goal is to make money. One way to judge how good they are at doing this is by looking at return on equity. So equity equals assets minus liabilities. Basically, how much money is in the business in terms of net assets. Return on equity is the percentage return in profit you get on that equity. If you have a high return on equity, it means that the business can get money and generate it into more money at high rates. It means basically that it's a good business. I recommend a stock to have a return on equity of at least 10%, and Buffett likes return on equities above 15%. You can find the return on equity metric by going to Yahoo Finance, go to the statistics section and scroll down to return on equity. The price to earnings ratio, as I said before, it's a great metric, but it's missing one key component: the growth of those earnings. This matters because if earnings are going to double each year, it affects the value of the stock and the return that you'll get in the future. The PEG ratio takes into account growth of earnings. It is calculated by dividing the PE ratio by the growth rate of earnings, and just like golf, you want this number to be as low as possible. The lower the PEG ratio signals the cheaper the price, the higher the earnings, and the higher the estimated growth. You can find the PEG ratio by going to Zacks.com to fundamental charts and click on the PEG ratio. Also, a lot of these ratios in general will come up when you type in the stock and the ratio that you're looking for on Google. Funnily enough, Google has the answers to a lot of things in life. As a business owner, two of the most important metrics to look at is 1, revenue, aka how much is the business making in total, and 2, earnings. After I deduct expenses from the revenue, how much do I actually keep? You want both of these numbers to be obviously as high as possible, consistent, and also very important, growing. Yahoo Finance gives you a nice overall picture so that you can see what's happening with these numbers. The green is revenue, the blue is earnings. So this is Apple stock. As we can see, both have grown nice and consistently, did very well in 2021, but also slowed down slightly in 2022. Also, you can go and check analyst estimates for how much they expect revenue to grow by in the future, and you can check how much earnings are expected to grow by if you go into the analysis section of Yahoo Finance. Yahoo Finance is a very good website for investors. By the way, now if there's one thing that we learned in 2022 is that debt is a dangerous game. Just go ask Sam Bankman-Fried, Credit Suisse, or Evergrande. They'll tell you how much trouble debt can get you into. If you get into too much debt, things can all come crashing down. But how do we tell how much is too much? There are 2 key ratios to look at to assess a company's debt level. First is the debt to equity ratio. This ratio compares how much debt the business has to how much money or equity the owners actually have in the business. Naturally, you want more equity than debt. The current ratio is also very important because it gives you a clue if the business can survive in the short term. The current ratio is a business's current assets minus current liabilities. So current assets are all of the assets that can be made liquid into cash within a year. Current liabilities are all liabilities that must be paid off within a year. What happens when you have more current liabilities than current assets? Your business is doomed to become insolvent. Warren Buffett likes a current ratio of at least 1.5, aka current assets are at least 50% more than the liabilities in the business. This ensures that they are solvent and sound in the short 1-year term. The economy is made up of sectors and industries. You want to pick out the sectors that will perform over your investing horizon. The economy has 11 key sectors. One is the technology sector. This includes stocks like Apple, Microsoft, Nvidia, IBM. 2 is the financial sector. This can be banks like JP Morgan or Wells Fargo. It can also include insurance stocks like AIG and Chubb. 3 is communication services. Stocks like Google, Matter or T-Mobile.